Hi, this is Ron Cipcic, and in this particular video we're going to take a look at long-run market adjustments in the purely competitive model. I assume that you've already looked at the other videos that I've offered on pure competition, so you now understand some of the fundamental theory concerning a firm and the market under purely competitive conditions. The models we have drawn here, let me just quickly review a couple key concepts so we can begin to wade into this adjustment process. The picture on the left shows a competitive market where you have a standard supply curve and a standard demand curve. And the assumption here is that there are many sellers and many buyers. And all of these sellers and buyers are interacting in such a way that we get an equilibrium price of PE1 and an equilibrium quantity of QE1. Notice that this picture is drawn in equilibrium, and if the market were not in equilibrium, we assume it would move towards equilibrium, so there's no reason to assume anything else. Remember that the firm in the purely competitive model is a price taker. So the price that is determined in the market, PE1, comes to the firm as a given. So the firm takes the price from the market. The market comes across to the firm, and the firm takes the price as a given. It can sell as much as it wants at the market price. Of course, if it tries to charge more than the market price, it can't sell anything, and it would be foolish, of course, to charge less than the market price, since it can get the market price if it charges it. We notice the picture on the right, the firm is in a profit position. How do we know that? The demand curve is above the ATC curve. Notice also that the firm is optimizing. You go, what do you mean by optimizing? It's operating where MC equals MR. Sorry, we have a little technical difficulty here. IKEA is trying to get a hold of me. IKEA will just have to wait because we're working and there's no time for buying furniture. Back to our regular programming here. The firm on the right is actually profitable, and we see that it's not only profitable but that it's maximizing profits. How do we know that? The firm is operating where MC equals MR. And again, if you do not understand that principle, or that principle is foreign to you, then you'll want to look at some of the earlier videos that I have on pure competition, and I explain why this firm would strive to operate where MC equals MR. Now, this must be a short-term profit position. You go, why? Well, in the purely competitive market, we have very easy entry and exiting. So it is very easy for firms to get into this market. It is very easy for firms to get out of this market. For instance, if this were the corn market, there are millions and millions of people growing corn. And farmers can get in and out year to year simply by planting a different seed, applying different fertilizers, basically using the same equipment. So it's very easy to get into these markets and out of these markets. If somebody wants to get out of corn and get into soybeans, fairly easy proposition. Somebody wants to get out of soybeans into corn, fairly easy proposition. So this firm, say it's a corn farmer, is earning a profit. It's in a profit position. However, that profit position will not last for long. You go, how do you know that? Well, let me just write out some logic down here. I'll write it out down here at the bottom where you can see that when a firm is earning an economic profit, that profit will lead to what we call entry. And entry will ultimately lead to falling prices, which will push the market towards what we call economic break-even. Economic break-even. And economic break-even is simply where the firm is not earning a profit. Now, what I would like to show you in this particular video is how that adjustment takes place. So we're going to modify this diagram, and I'll change the color of the ink here. And I'm going to get my ruler tool working, and I'm going to move my ruler down. Notice that I'm setting my ruler just tangent to the minimum point of this ATC curve. So I'm going to basically draw a dotted line across here, and we come over to here. I'm going to leave myself a little room to write in the new price. and I'm going to make this a solid line because this is actually going to be the new DMR curve. Okay? Now let me, I've just got a few more little things to do here, so let me adjust this again using my very fancy ruler function here, and I want to get that to be 90 degrees, so we will do that, and I'm going to push that over here, and we will see that this is an important quantity, and I'm going to move this over here, and we'll see that this right here is an important quantity. Now I will explain all of this. I just need to get the graph set up to basically do this. Now let me move my ruler tool over here. What happens when firms enter the market? That becomes the question. Well, when firms enter the market because of a profit position, that supply curve, that market supply curve, is going to what? It's going to move to the right. So what I want to now do is I want to draw in a solid line, and this is going to be our new supply curve. Okay? And I'm going to label this S2. And what caused this movement to the right? Basically entry. Now earlier in my videos, when I talk about factors that shift the supply curve, when I talk about non-price factors that shift the supply curve, one of the non-price factors that I indicate that shifts the supply curve to the right is an increase in the number of firms. So when firms see that existing firms are earning a profit, when they realize that existing farmers, let's say, are being very profitable growing corn, and the word starts to get around, boy, growing corn is a very profitable endeavor, more farmers are going to want to enter this market. That supply curve is going to drive to the right, and we call that entry. Entry can only occur in the long run. Remember, in the short run, the plant size of the firm, the scale of the firm, is held constant. In the short run, you cannot change the scale of operation, which means firms don't have time to get in. They don't have time to set up and get into the market. So the assumption is in the short run there can be no entry. Entry is a phenomenon that happens in the long run. So as that supply curve drives to the right, you should see that the equilibrium price is falling, say equilibrium price for corn, and the equilibrium quantity of corn is increasing. So the equilibrium price falls and the equilibrium quantity increases. Okay? And of course that feeds over to the firm. Remember, the market affects the firm, but the firm does not affect the market. Let me say that again. The market affects the firm, but the firm does not affect the market. So the firm is a price taker, and the existing firm, the firm that was once profitable, is going to see its profit position basically dissipate away. You go, what do you mean? Well, as that DMR curve moves downward, the profit is shrinking. You can see the gap between the demand curve and the ATC curve is actually getting smaller. All right, so that profit box starts to shrink. And firms will enter so long as there is a profit. When will firms stop entering? Firms will stop entering when the existing firms are just breaking even. And that's going to happen at P2, QM2, which is right here. Okay? So now the DMR curve has dropped. And it has dropped because of entry. As firms have entered, the price has dropped, pushing down the DMR curve. When will firms stop entering? They'll stop entering when we get here to point 2. Why point 2? Because at this point, firms are just breaking even. Now this point right here is a fascinating point. You go, why? Because at this price equals ATC, which means we have a break-even position. But ATC also equals MC. But that's not the end of the story. MC equals MR. So there's three things going on here that's really fascinating. One, you have break even. You have break even. Price equals ATC. Now this is economic break even, not accounting break even. The firm is still showing a profit from an accounting standpoint, but from an economic profit standpoint, the firm is breaking even. When you include implicit and explicit costs, the firm is just breaking even. So we're breaking even. We've got economic break even. Where is the break even taking place? The break even is taking place at the minimum point of the ATC curve, which is very interesting. In the long run, the competitive market generates long run prices that are very, very low, relatively speaking. In fact, so low they're at the minimum point of the average total cost curve. The last point to be noted here is that this is optimal, that there's no better alternative. So the firm isn't going to want to operate at a lower output rate than QM or at a higher output rate, because you can see out here that the firm would be losing money. ATC is greater than the demand curve, and over here the firm would be losing money. ATC is greater than the demand curve. So the best the firm can hope for in the long run is to break even, which reiterates the point I started with here, that economic profit leads to entry, entry leads to lower prices lead to economic break-even. Now there might be a little bit of confusion here concerning the quantities, so let me address this. We see that in the market as a whole, market sales increase, but we see that each existing firm is actually selling less. Now that can conflict people. Remember, when this supply curve is shifting to the right, that's due to the increase in the number of what? The number of firms. So as the number of firms is increasing, actually the quantity supplied is coming all the way out to here. Okay? But then the price begins to drop, and some of the firms, not some of the firms, but we assume all of the firms are going to cut back on their output rate. So you've got really two things happening here. You've got more firms in the market, more people growing corn, but as the price of corn falls, existing farmers aren't going to want to grow as much. And so this is looking at the existing farmer. Each farmer actually grows less, even though we have more farmers. So the overall market ends up producing more, but each farmer produces less, and unfortunately for the farmer, is not only producing less, but is breaking even on what is sold. All right, so this process also runs in reverse. And let me just conclude with this thought, that if firms are in loss positions, which I'm not going to draw, I'm not going to show you the flip side of this, but you can reason this through. If the firms are in loss positions, you have just the opposite happening. If we have an economic loss, we would expect that firms would exit the market, particularly the weakest firms. As they exit the market, the supply curve would what? Drive to the left. As the supply curve drives to the left, the price would go up. As the price goes up, firms would move from loss positions closer and closer to break even, and firms would finally stop exiting once they're breaking even. So in the long run, we would expect break even, whether firms are starting in profit positions moving to break even, or firms are starting in loss positions moving to break even. All right, that concludes our video on long-run market adjustments in a purely competitive case.